So I have someone who helps me choose where to invest in and advises on how much I invest. To be honest,
Nikigongo na stock broker na kampuni ikianguka na pesa yangu
Bro, cha kujistress kuhusu hizi. Dosika has a solution to all your problems. Nacheki.
Introducing Dosika, a mobile app that is designed to make the Kenyan capital market accessible to everyone with a simple-to-use interface. The app provides real-time updates on stock prices and news, which is crucial for investors. Dosika ni investment chap-chap mkononi. Are you looking to start investing in the Kenyan stock market? We have just the solution for you. Introducing Dosika, a mobile app that is designed to make the Kenyan capital markets accessible to everyone with a simple-to-use interface. The app provides real-time updates on stock prices and news, which is crucial for investors. Here's how to sign up. Download and install the Dosika app from the Google Play Store. Create a Dosika account by signing up with your email address and phone number. Once you've signed in and linked your account, you are all set to start adding securities to your watch list or portfolio. To track the performance of your portfolio, go to the Portfolio tab and view your holdings. Dosika ni investment chap-chap mkononi. Dosika, grow your wealth.
Good evening once again, and thanks for joining this webinar. Today we're going to talk about the do's and don'ts when investing in the stock market, and we shall unpack that what it means during the presentation. But maybe just an intro about who I am and what we do. So my name is Steven Atema. I work with the Central Depository and Settlement Corporation, Kenya, and our main role is to do depository and settlement functions for securities that trade at the Nairobi Securities Exchange. When I talk about security settlement and depository and settlement, I basically mean when all the shares in the Nairobi Securities Exchange and corporate bonds are held in safe custody under the central depository system, and that's why when you want to trade in shares, you open what we call a central depository system or a CDS account. So we are the custodians of that account. We're the ones who manage your holdings and ensure that they're safe. And when you do the trading in the stock market, whether you're buying or selling, then we also participate. We are also the guys at the back end who are supporting the settlement of those securities to ensure that the buyer gets his shares and the seller receives his money in good time. So part of why we do this is to help investors such as you to make informed investment decisions, because we believe that when you are an informed investor, you are not only a protected investor, but you also enjoy your experience in the capital market. So today we have one of our good speakers. He's called Ronnie, and maybe he'll introduce himself and tell us what he does at the company that he's in, and then we can carry on with the discussion. Welcome.
Thank you so much, Atema, for the warm welcome. Good evening to all our listeners this evening. My name is Ronnie Choka. practicing as a research analyst at Capital A Investment Bank. I'm an economist by training, having graduated from Kenyatta University, pursuing economics and finance. I've been fortunate to work at now 3 investment banks, covering equities and macroeconomic analysis, East African financial markets. And it's a pleasure once again to be back on the show, Steve. Thank you.
Oh, nice, nice. That's a serious. We have a serious speaker here. Three companies, three. All of them in the capital markets, and so you can be sure that whatever Ronnie is giving you is not only based on experience but also his competence. I don't know, Ronnie, since we are talking about how people are losing money in the stock market or any other investment, actually, do's and don'ts to maximize your investment return. I don't know if you yourself have lost money, whether in the capital markets or anywhere else, and what you might have learned from that experience.
Well. Thank you. I think, yeah, one of maybe the financial mistakes maybe I did once was, failing to, plan and budget, for especially in my first working year. I was more of an impulse buyer. I wasn't, really paying attention to how much I was spending per se. But I quickly came around and, started, because you come to a certain point of the month and you're like, how did I really spend my money? So
Is more
you're
month than
almost
money.
more month than money, exactly.
Yeah.
So yeah, but in any case, I think that is surely behind. Now we even have budgeting apps. It's even much more easier
Yeah.
nowadays. Yeah.
Nice. For me, my biggest investment mistake was was investing in FX. So I did
Okay.
not know that the only people who make money in FX are trainers and people who do FX on a daily basis. So I wanted to do FX as a diversification strategy. And I dare say that when you see CMA, for those who have invested in FX or participated in FX, there is usually a disclaimer down there. 75 to 95% of people lose money in FX.
Yeah,
So I
exactly.
can confirm to you I'm part of the 95%. So anyway, I did that and but here I am. So yeah, that was my experience. But I'm sure you guys are not here to listen to our stories. We are here to talk about the do's and don'ts of investing. So I'll just let you, Ronnie, take us through the presentation, and if you have questions, please hold them or you can share them on the chat, and then we can discuss them after we do the presentation. Take it away, Ronnie.
Thank you so much. I have a short presentation in line with the theme. Let me present my screen. Uh, is my screen visible?
Yes, you can turn off your mic, your cam now, but
Yeah,
maybe
let me
put it
turn
on
the
presentation
consistency.
mode.
Okay. Great. For those who just joined, my name is Ronnie Choka. I'm currently working as a senior research analyst at Capital A Investment Bank, leading investment bank dealing with brokerage of stocks, treasury bonds as well. We recently rebranded from Securities Africa, and apparently, we're growing by leaps and bounds. So, Capital Investment Bank, we are located at Mayfair Suites along Parklands Road, and we are happy to welcome you to partner and trade with us and choose us as your wealth management partner. Diving straight into the theme of today. Today our theme was investment do's and don'ts. And before I get
Ronnie,
into
you might want to put it in PowerPoint mode for those who are using small screens.
Oh, sorry. Let me do that. So thank you. Before I delve into the investment do's and don'ts, I'd just like to give a short context as to how the equities market is performing as of Q1 2025, just to give our audience an understanding of how things are shaping up, even as we delve deeper into the theme of today's meeting. So last year in 2024, we saw a very striking turnaround in the Kenya's equities market. In 2023, some of you may recall, our equities market wasn't performing so well. It was ranked by some as the worst performing market. But in 2024, there was a very sharp turnaround to become even the best performing market in USD terms. And this was largely aided also by, improved corporate performance on the one hand, but also the strengthening of the Kenya shilling on the other hand was also a good factor that propelled overall performance. We are seeing increased investor participation, both by domestic and even foreign investors, as they move to take advantage of the very discounted, very cheap stocks in our market with very strong earnings potential. Coming into 2025, we've seen that momentum spill over. On a year-on-year basis, turnover was up 40% to around 26 billion. Wealth creation has also improved by 16.4% year-on-year, as measured by the market capitalization. And if you look at foreign activity, that has also largely flatlined, especially now with the onset of the tariffs introduced by the United States. That has brought a lot of uncertainty, as you can imagine. And that explains why we're seeing intensified foreign sell-offs in the first quarter of this year. But all in all, the participation by domestic investors remains to be admired, and the market is still resilient despite these shocks. And it is important to be cognizant of the context or within which we operate, because if you see, for instance, this chart here, it shows you the trend in the all share index over the last 10 years. And some of the largest single day drops in the market have largely been associated with, geopolitical events. The latest being the Trump tariffs, which caused close to just 2.5% downside in a single day. We've had other worse days behind us, but the market generally is on an improving trend. If you look at the most traded counters so far, as usual, Safaricom continues to lead the pack, largely being supported by foreign activity. KCB has come in second with a turnover of around 5.5 billion. And on KCB, the dominant participants have been domestic investors. In that place, we had Equity Group with a total turnover of around 2.6 billion, and the bulk of it being supported also by domestic investors. If you look at most of the top 10, most of them realized positive earnings or positive valuation gains on the first quarter, led by HF Group, which gained 53%. We have Kenya Power right there, which gained 40.5% in the first quarter. The other blue chips like Safaricom, 7.3% gain in the first 3 months of this year. Standard Chartered 7% gain in the first 3 months of this year. And this chart also gives you now a sample of the most liquid stocks. Liquidity is also a very important factor to consider when investing in a counter, because you don't want to, invest in a stock which is, hard to to sell whenever you wanna exit when the time comes about. So this in itself gives you a very good sample portfolio for you to even consider starting with. If you look at the top gainers in the first 3 months of this year, we've seen very strong triple-digit returns. However, some of the counters here are, a penny stock. Some are not even operating as we speak. So this points to some increased speculation activity in the first quarter. But all in all, that's not to say that there are not genuine winners in the list. We've seen very striking turnarounds in companies like Liberty, HF Group, Kenya Power, and even East African Cables, which explains why the market has rewarded them with very attractive positive valuations. And the reason why I gave this context of this market performance was for us investors to appreciate, first of all, the context within which you find the market. We've come from 3 years of very, very uncertain times for financial markets. Back then from COVID-19, we went to the Russia-Ukraine conflict, which caused which sparked a lot of inflation globally. As a result, central banks decided to raise interest rates sharply to combat the inflation. And as a result, we began to see economic growth slow down. So did demand for credit in the private sector dwindle as a result. However, things are starting to improve, especially towards the end of 2024. Inflation, moderated very sharply. Like inflation in Kenya is now at just above 3%, which is below, or within where the central bank would like inflation to be. Interest rates are also now starting to come down. However, more recently, we are starting to see again resumption or a rise in uncertainty occasioned by the Trump tariffs. But going by the latest news, Trump is making a U-turn on the tariffs levied to China. So we anticipate that the market will remain stable at least over the coming quarters. And now this leads me to the question, why investing matters? So for those who may be wondering, why is it important to, investing as opposed to speculating or, even being indifferent? You may not be very keen, paying keen attention to the need for investing as a critical activity. Yet, if you look at some of the reasons we advance, including meeting living expenses, which tend to increase during the lifetime of an individual or a family. Secondly, I mentioned inflation, and this is simply the loss in purchasing power over time due to an increase in price levels. So it's only by investing can you keep up with this rising price levels, which is almost a fact of life. Thirdly, it's also good to invest because certain times there may arise emergencies emergencies within which we may need liquidity to take care of. And of course, to realize your lifetime goals, be it even going on holiday or, whichever it may be, even pursuing higher education, investing is surely a path to unlocking your lifetime goals. So the theme of today's meeting was investment do's and don'ts. And I thought, let me start with what are the factors or the elements of behavior that, people commonly practice subconsciously or otherwise that may be taking them away from the path towards successful investments. and I've gathered a list of very few critical points that investors should pay heed to in order to, avoid distress in the investment world. So the first element is trying to time the market. And by trying to time the market, this is simply the behavior of trying to buy an asset low and sell it high. But in this case, you are not paying attention to the company's fundamentals or industry fundamentals, but you are simply looking at, maybe a graph or a chart. And the challenge with this is that it's very difficult to predict when a market turn will come about with accuracy. So this behavior of technical, they call it technical analysis. I know there are schools of thought which are highly in support of technical analysis, but more often than not, without experience, you may end up in losses by this behavior of this investment practice. Secondly, the second point is another factor that you need to avoid is concentrating your portfolio on single investments or a single set of investments or a single asset class. So we've all heard of the need of not putting all your eggs in one basket. And it's very true also in the investment world. Putting all your money in one asset class is not only very risky, but you can miss out on you limit your opportunities to realize better returns. Should especially because now the sampling error is that you've you've put all hope in this one single investment realizing growth. So I think that analogy speaks for itself. The third element or the third point that people need to, and maybe this should have been the first point, is lack of a clear investment plan. Oftentimes you see investors approach the markets without having a set of defined goals, defined objectives or targets that they want to achieve using their investment plan. It is also, some also do not have definite time horizons. Are you okay? How long can you afford to reinvest your surpluses from your investments, and also how tolerant are you to risk as an investor? It's very important to answer, especially that question on risk tolerance, because we often see people uh, indulge in what I describe as risk-seeking behavior. And this often happens when we see investors, whenever there's a slight loss on your portfolio, investors tend to panic and then take another set of actions in order to compensate for the loss that on the downside lead them to suffer even bigger losses. So this can only be avoided by first answering the question on how tolerant are you to risk. If you are conservative, that will imply a very conservative set of investments for your portfolio. However, if you are more risk tolerant, if you can optimize your risk or risk return ratio, such that you are also compensated enough for taking that extra risk. And number four, another factor that investors should avoid is, not having a clear product understanding or not understanding how an investment works. And, in this day and age, we have a growing set of very complex financial instruments. We have crypto assets, derivatives, we have meme stocks, and so on. all of which, some of which are very, very volatile, some of which are also unregulated. So there's no investor protection. And this exposes retail investors to, undeserved losses, or because you did not take time to really understand the product. Maybe you went with the populace, and didn't really take time to dig deeper or a little deeper into how that investment really works, or whether it's regulated in the first place. Another factor or another point to avoid is chasing past performance. We call it recency bias. This is the tendency to think that because an investment delivered very positive returns in a previous period, that trend will continue even in the subsequent period. So that in itself is misleading, or because past performance is not a guarantee of future performance. So it's very key that you understand the context within which you find the market as you try to invest, such that you are not carried with the wave. You're not carried with the wave of the market, but you are very keen more on spotting undervalued opportunities, because that's how you can make money. There's a risk of overvaluation as well, and the market also, corrects that by downward valuations. The other point is, neglecting inflation risk. I talked about inflation in the previous slides, and how it decimates your purchasing power as an investor. So as you say, seek even these very uh, conservative investment options like fixed deposits and call deposits. It's also important that you factor in the inflation risk when you're pricing the bank or whichever institution you're approaching for your fixed deposit, because failing to account for that means sometimes inflation can outpace your rate of return, which again beats the purpose of investing in the first place. And lastly, of course, among many other points, but for today, the last point I think to avoid is overconfidence in the market, which is the false belief that you can consistently beat the market, that you are always right in the market. The market has a way of humbling the most proudest of investors, that we've seen time and time again. So it's very important that you make information your friend, keep abreast with the latest news and information relating to your investment, such that you'll always have an upper hand, and you'll also be humble enough to recognize when your investment is starting to take a different turn, at least early enough. And you can only do this by avoiding overconfidence. So now I can proceed to the question: what are the do's, or what are the set of actions that I would recommend investors to take on as they invest in our capital markets? So the first point is proper investment planning. I talked about the lack of a clear investment plan as a very key hindrance to investors realizing successful returns. However, in this case, when you set specific goals, I'm talking being very clear on the amount of money you tend to raise by a certain date, and develop a clear roadmap to achieving it. You know your goals best, depending on where you are. It's planning for retirement, planning to purchase your first home, planning for education for your children, and so on. It is good you note them down and have definite dates and amounts, and then you can allocate, your time and energy and resources towards achieving those goals. Of course, sometimes you may need a financial advisor, and I'd highly recommend you pursue a reputable or a qualified financial advisor to aid you in the process. Whenever you do proper investment planning, it sets the course for the achievement, or the realization of your identified objectives. However, the converse, whenever you fail to identify specifically and just being you know indifferent, uh, over time you find that you may not really achieve your goals within the time you desire. Secondly, of course, it's good to review track record performance uh, relating to your investments. This is basically, even before you invest, it's good to take time to analyze how has a particular investment or particular fund been performing over the past, let's say, 5 years, such that you have a better grasp as to, what to expect as you head to the future, within reasonable expectations. It will give you a better understanding of the risk profile of that asset class, and you'll now be able to filter whether that asset class aligns with your portfolio strategy. The third point is, as an investor, you need to understand that there is for every project, or for every investment endeavor, there is always an element of risk. And we usually say, don't assume stable equals safe. Yeah. Generally, all investments bear some level of risk, however low. So it's good to take time to question, or to, think of the risk profile of each asset class before, or even as you allocate your weights to your portfolio. The fourth point is diversification. This is now the opposite of what I told you not to do. That is putting your eggs in one basket. So what we recommend, diversification across several asset classes, and also within asset classes. We have equities, we have real fixed income assets like bonds, corporate bonds, government bonds, and so on. We have real estate also as an investment class. And you can also invest within asset classes. So, for instance, with equities, you can invest um, within, let's say, you can diversify across sectors, like, for instance, the banking sector, the energy sector, manufacturing sector, telecommunication sector, and so on. You can also diversify geographically. That's also another way to, spread your risk. The fifth point, or the fifth recommendation, is to seek proper product knowledge. And this is why I usually say, only invest in what you understand, or work with an qualified advisor to aid you in the process of investing. This will help you avoid, the downside, or the adverse downturns in your portfolio. And another element, or another phenomenon you're seeing is, leverage is not a bad thing. However, we usually recommend investors use it very sparingly, and only if you understand the downside risks for that investment. So leverage in itself is not inherently bad, but it needs to be used very judiciously, very carefully, since, if at all a risk materializes, that loss is compounded. But if you do it very carefully and very judiciously, then you can realize some good profits as well. The next point is understanding fundamentals. So in the don'ts, I said at first that you need to invest in a stock or an asset class whose fundamentals you understand and whose long-term strategy is sound. Yeah. Basically avoiding the investing based on hype on the, let's say, on the internet or from, friends and so on, but taking time to understand how an investment, the flow mechanism, right from when you plow in your funds to when you reap the rewards. I think at that point, that's all I had prepared for this evening. Maybe I can take the microphone back to you, Steve, for your guidance. Thank you so much.
Thanks, Ronnie, for that detailed insight on what we should not do. But even as you're presenting, a question came to my mind. You're saying that sometimes, not even sometimes, we are not supposed to time the market, but almost every time there is a market dip, we are always told you should be buying the dip. So should we be following that advice, or how should we approach such guidance? Especially sometimes it's even coming from analysts such as yourself.
Great. Yes, we usually recommend buying the dip, especially for, fundamentally sound companies, largely because whenever there's maybe a slight market dip, this could be within the ordinary fluctuation range of an asset class. So it's not necessarily true that once you see any negative slide in your investment, you should, rush to sell. That phenomenon we call panic selling, which can be very costly. You can you can end up selling at a very big loss if you panic sell. What you need to do is to be very judicious again, relating now to your risk tolerance. You can then proceed either to dollar cost average. Yeah. This, and by dollar cost averaging, or maybe I can say shilling cost averaging, that's the process of, lowering your weighted average purchase price. So whenever your investment or whenever share prices, say for instance, are dropping, that presents an opportunity for you to lower your weighted average purchase price, and that positions you for even greater takeoff once the market takes on an upswing. But
Okay.
yes, I do understand.
Mm,
For some very risk-averse investors, they may not be very tolerant of that, and that's why I'm circling back to your, the investment policy statement and what risk tolerance you are able to allocate or to stomach as an investor.
okay,
Yeah.
that's good. How much diversification is too much? You can diversify yourselves out of returns. Mm,
Yeah, in as much as I'm encouraging diversification, I wouldn't encourage excessive or spreading yourself too thin.
mm,
Because for one, there are only very few options that can deliver that very attractive return. So by that in itself, it implies you need to be very selective as you diversify.
mm,
Yeah, so you need to be very picky, even across sectors. Pick the best performing counters per sector. That way, I think you will stand a better chance than someone who aims to invest in everything and ends up realizing nothing.
makes sense. So I should diversify selectively. And I
Selectively.
think to add on that, I would just say, even when you're diversifying, always consult a financial professional, because most of the time, even the diversification that you're doing, sometimes you're better off even just being in one counter as long as you have the right, you are investing that counter with the right understanding of that investment. So yeah, diversification, but very selectively, because you might also diversify, but you're also diversifying into bad counters. So that's important.
Exactly.
And then you had shared something in your earlier presentation on the times when the market has tanked, and as an investor, I wanted to know, or I wanted maybe some guidance. When How do you handle emotions when, especially during times of volatility? Because you can have invested in a solid company, a solid fundamentals, but the price continues to tank, or the price goes up, and then you are almost tempted to double down on your investment. How do you handle emotions when investing, especially during volatile times like we are in now?
Okay, yeah. So emotions can play a huge part in, altering your path towards long-term returns. And as an investor, it's very important to stay grounded, in the sense that you need to circle back to why you invested in the beginning, and looking to see whether that storm is temporary, or it's likely to persist. Some shocks, are very temporary in nature, while some can extend for much longer. So it's very important to give benefit of doubt first, such that you can avoid the panic selling. Sometimes panic sales can be induced in the market, uh, especially now globally speaking. You can see the kind of politics you are seeing, the Trump tariffs. The market goes down very steeply one day, the other day, the next day we are seeing very attractive returns. And you can't help but think, was this choreographed? With the geopolitics going on globally? So it's good to stay grounded and look beyond temporary shocks. It's also good to consult, read more, or gather more intel regarding investments or basically intel that affects your asset class, such that net you can arrive at an optimal decision. Because there are generally times then when you should take the signal and exit, especially when a company, for instance, issues a profit warning. That in itself is an indicator that the share price is likely to go down. So there are genuine times when yes, you should exit, yeah, and there are other times when you should look beyond that temporary shock and stay invested, and maybe even double down on your investment.
Yeah, okay. There's a question here from Elijah. Maybe you can just answer it quickly. Can we day trade stocks?
Yes, I believe maybe if we stand guided, but I believe we now have day trading on our equities market. It is an option provided even on Dosika, and even on many investment trading apps nowadays. So yes, it is possible to day trade, but more so on the liquid stocks.
Yes.
That's when you can day trade effectively as a trader.
Now, in investing, sometimes most investors, that dollar cost averaging proposal that you've given. Sometimes as an investor, I have dollar cost averaged all through, maybe for the last 1, 2 years, 3 years, and I want to know if if I'm making money. How do I, as an investor, know I have been buying shares at maybe this type of price? How do I reach a point where I know, okay, I'm making money, or I am in losses? How would you advise or help such an investor?
Yes, so with dollar cost averaging, remember you've bought let's say the same asset, but at different prices. So what you are doing is simply getting the weighted average price of your investment, from which now that forms your base. And now you can ascertain between my weighted average price and the current market average price, what is the upside potential I have? So whenever market prices are going down, if you continue buying even despite the downtrend, so long as you are investing in a fundamentally sound company, you have the effect of lowering your weighted average price, such that now when markets recover back to the fair value price, you have a bigger upside potential compared to someone who did not execute dollar cost averaging.
Yeah. So for any novice or any investor who is not active in the market, and you have found a solid company, I think the best strategy usually for you is to dollar cost average. And I always say, look at it this way: the same way you put money consistently in your chama, the same way you put money consistently in your MMF or in your insurance premium or in whatever type of investment that you have, is the same way it is expected that you should be putting money in the stock market. So for some reason, people have a mind shift when it comes to stock market, that they are hoping to buy low, like you said, and sell high, when the expectation is you are also supposed to compound your investment over time. And like you've explained well, definitely when you do that, most of the times you'll be in the money. And the way these apps are also set up, the platforms from these brokers such as Capital A, is that every time you purchase, the platform recalculates your average investment, and it will tell you whether your current investment based on the average price is at a loss or at a profit. So you don't even need to do the calculations, because that question was somebody, I guess, who was thinking, how do I need to sit down at the end of the year and now calculate what is the average price of my... The system will do that for you, and it makes things very, 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 very simple. Now, before, there is also another question. What are some of the reliable sources or indicators of spotting that, this is a good time to buy a specific maybe share? How do I know when it's... Of course, we've been told not to time the market, but usually there are also some telltale signs that this is a good counter to buy. Assuming I'm starting today, what would be some of the things I should look out for in a company that I want to buy?
Great. So there are a number of factors you can look at whenever you want to decide whenever you want to tell whether it's a good time to invest. All the way from industry level, there can be changes in regulation that can favor an industry. Let's say, for instance, for example, when the Central Bank of Kenya gave approvals for banks to roll out risk-based pricing, that gave banks power to, price for unique customer risk. That in itself was a benefit or a policy that supported the earnings for majority, if not all, of the commercial banks. So that's an example I use of illustrating at industry level changes in policy that can aid or can support the decision to invest in a particular counter. But that also has to be complemented by, sound financial statements within that industry, or relating to the particular company you want to invest in. So it's if you're looking at say earnings momentum, very strong double-digit or even triple-digit growth in earnings is usually an indicator that it's very, very ripe to consider investing in that stock. Another factor is consistent dividend policy. Companies with with a track record of consistent dividend payouts can also be a promising, can also be the go-to option for you as an investor whenever you want to pick or consider that stock. The third element is looking for discounted price multiples, price multiples such as the price to earnings or price to book ratio. That can help you identify discounted counters, especially when, let's say, for companies, let's say in the banking sector, even the energy sector, if companies are trading below the industry average price to book ratio, then it implies, in a sense, that you are looking at a very undervalued stock, and as such, it can be a good opportune time for you to invest in that counter.
Yeah,
There's that alongside, of course, many other qualitative factors aside from the numbers.
Yeah, but some
Yeah,
announcements such as that, and that's why
yeah,
even if you're investing passively, you ought to always have your like have some way of getting to know what is happening in an industry that you're invested in, whether it is
yes.
through the news or whether it's the papers, or even just checking in with your stockbroker once in a while to ask what is happening, what are the opportunities in that space. There was a question about CDS statements, CDS account statements. We usually share statements in the months where you have activity. So Vincent, if you've not had that, if you've not received your statements and you traded in that month, then probably it could be that the statements are going to your spam, or that the transaction had not settled in the month that maybe you traded on 29th and it settled in the next month, so you'll likely not receive your statement at that point. But anyway, either way, you can just email us at helpdesk@cdsckenya.com, and we shall guide. Then share insights on stock splits. I'm not sure what the question is. Do you have an idea of what the question could be intending so that you can guide Ronnie? Or are you asking whether stock splits are an indicator of maybe a company price going down or up? Ronnie?
Yes. So with stock splits, they usually have the effect of, depending on the ratio of the split, they usually have the effect of reducing the share price and doubling the amount of shares in circulation. Think of the bonus issue, the one-for-one bonus issue that Kenya re-executed in August 2024. That in effect functioned like a stock split, because for all the shares in existence, they increased another extra share in the market. And you reckon that the share price almost actually halved in value on the resumption of trading after the crediting of shares. Does it imply gain in fundamental value? At the onset, it does not. It's usually calculated to leave the market price basically very indifferent to changes in fair value, because if let's say you had 100 million shares in the market at 10 shillings. If you are doubling that to 200 million shares in the market, then it must mean that the share price has to halve in value, because there is no fundamental change in the earning structure to warrant an increase in the market capitalization with a stock split.
Yeah.
So in essence, there's no fundamental change in the company's fundamentals earnings. Until then, that's when we can say there is a leg room for price appreciation. But all in all, I think stock splits are a good way to give the market or give investors some very good runway for capital gains. With stock splits, especially for the most expensive stocks, that can attract more demand for the stocks in itself, and support some very good capital gains.
Yeah, thank you for that. When dividends are paid, do you get statements? No, because they're not an activity in your CDS account. Shares payment of dividends, unless it's bonus dividends, payment of cash dividends happens to your bank account and not necessarily to your CDS account. So no, you won't get a statement. However, you can always email us at helpdesk at cdskenya.com and you shall get your statement. It's a free service at the moment. So even if you don't get your statement, you can always email us. The same way I've advised Vincent that you should when you don't get your statement, you can always email us. And the CDS statement that we share is usually consolidated. So whether you have 5 brokers, 2 brokers, or 1 broker, the statement captures everything. Closing remarks, Ronnie, even as we wind up.
All right. Thank you. It's been a delightful evening, Steve, and alongside all our distinguished guests. I really do hope you've learned something or you've taken home something today, and that you'll not just listen to it and that you will proceed to execute and action and, take note of the pitfalls, the common pitfalls many investors make, such that by the end of the year, your portfolio will be, or you will be smiling all the way to the bank.
Yeah,
Thank you so much.
Thank
It's
you.
always a pleasure to be on your show.
Thanks, Ronnie. One more question before you leave, so that my guest Justus doesn't feel like you left him hanging. He's asking about what your thoughts are in terms of the DRC requirement. I think there's a requirement by the DRC government for banks to, I think, reduce their shareholding. There must be some number of I think it was 30%. Maybe you can comment on that. And for people who want to start investing, there is also that link on Dosika. Please try it out and share your experience. But please guide our guest about what this might mean for Equity and KCB in terms of them reducing their shareholding in the regional subsidiaries.
I think I can take on this with Justus. Once I gather farmer intel on the particular query he has, maybe I can side chat him and carry on
you
the
can share your
conversation.
email,
Yes.
the group email that and in any case we shall share it in the presentation when we share the presentation. Actually, we always share presentations to the people who attend, so you shall be sure to receive their contact information. There it is, research at caib.co.ke. It's been nice having you, Ronnie. It's always a pleasure. It's been nice hosting you guys. I have enjoyed myself. I hope you have learned one or two things that you shall take home and hopefully you shall act on the information that we give. It's been a pleasure. Have a lovely night and happy investing. Bye.
Bye. Thank you so much.